Okay, so now you're talking about stop losses and you're talking about risk management. This brings me, so I can now take two questions. So there's a question that was asked to me last week on Friday, I believe, by one of our funded traders, and I'll take your question and merge them together. Okay, sort of discussing stop losses and risk management. Okay, especially in sort of times like this now, times like this. So to do that, let me just clear my screen first of all, and I do need to sort of bring up that question that was asked. Just give me a second. Right. Okay. Okay. Right. So one of the key sort of questions that was asked to me is, how do I determine a correct stop loss? How do I first of all determine a correct stop loss? And especially sort of in times like this, right, where over the last month we've seen an increase in volatility. Volatility has gained. Have a look at the volatility index. You should be able to sort of define that. Let's see if we go to currency. We go into the VIX. This is the volatility index. It's going to slightly drive higher, but if we go to sort of the 1 hour time frame, look at where the VIX it has been over the last since the beginning of March. Okay, since the beginning of March, this is what the VIX has done, right? It has gained. I mean, remember, what is the VIX? The volatility index is the volatility defined in the S&P 500. But to give it a very specific name and what it's known for, it's a gauge of fear, right? That's what it's gauging. It's gauging how much fear is there in the market, how much panic selling takes place. And if I can see, if I go to the sort of daily time frame, now we're looking at these numbers over here. If we sort of scroll back, you can sort of go, the last time we saw those numbers taking place was in sort of late 2008, early sort of 2009. Okay, and that was when the last recession took place, right? So we are in an extremely volatile period, and you need to now define how you trade. I have done a webinar on this previously, how you should be trading in this type of market. Now, if I come back to sort of the asset that I was looking at, okay, go back to sort of a 15-minute time frame, maybe a 5. Stick to sort of intraday view. Right. So just to highlight, the first thing I'll probably say is that in times like this, you need to increase the probability of your trades. In times like this, you need to increase the probability of your trades. And as I stated earlier, remember there's 3 types of positions you could take. You can go long, you can go short, but you can also sit on your hands. Okay, not taking a trade is probably a great time to do this now, right? All right. The last one is you get slipped or a gap takes place or whatever. You know, these are uncertain times to trade in, and you don't want to be hit and knocked out of position very quickly due to one, not setting realistic targets. 2, having too tight of stop losses. I'm starting to see that. A lot of guys, I've spoke to one of the traders from last week, and you know, he's up on his account. He's up on his funded account, but he lacked that confidence. He lacked that confidence, and one of the areas that we asked him to work on was the fact that set realistic targets and go on to review your ongoing trades and define, does market price, when you enter, go on to hit your stop directly? And if it does that, then you need to define thereafter. You need to watch that asset thereafter and see what happens. Does it hit the stop loss and then recovers and goes to your target? That means then your stop loss is too tight. You've got an incorrect stop loss. Or does it continue to go against you, which is now telling you that it's your trade idea? So you need to work on your strategy. You need to work on your entry, right? Reason for taking that trade. So it's about outweighing probability of the setup and the stop loss that you define. Okay. And then in times like this, it's key when you define a stop loss. Okay, so I'm just going to go through sort of some of the things sort of I have written here. I'm just trying to look for those key points. This is it. Okay, now it's defining a stop loss and defining an in-trade management process is probably the most difficult part. I think if you're in your early days of trading, the first thing that you need to focus on is just defining a good stop loss and then defining a good target, a realistic target. Okay. Now your stop loss should always be your worst case scenario, which means that at what point you determine that trade idea is no longer valid is where your stop loss should be. If your stop loss is in a region where the market price starts to go against you and you have this fear and you quickly close that position, that means you're risking too much in the first place, right? So manage what your expectations are. Always have a stop loss defined in defined at a point where it shows you that your trade idea was incorrect. And it should be allocated, and the monetary amount should be allocated to a point where it doesn't impact your pain threshold, right? Your personal sort of pain threshold, right? I remember we had a trader from sort of a previous company that I worked for who, did some training. He already had sort of the fundamentals in regards to trading. He really understood the fundamentals. He came to learn sort of more of the technical side of things. And when he left, he was working part of a hedge fund. The hedge fund gave him a large sum of money where he was taking 0.2, 0.3% risk on his account, and that was a decent amount of money. He was taking £2,000 to £3,000 on a single trade, on the position, right? He wasn't used to that before that. He wasn't used to losing £2,000 to £3,000 on a single trade, right? So, he kept on taking a trade, and when it starts to go a little bit against him, he'll quickly close the position, assuming that that's it, it doesn't work. And then after sort of reviewing his trades thereafter, some of those positions went on to hit his target thereafter anyway. So what he's doing is he's expecting the market to go only in one direction and that's it, right? So the problem was more that he was not comfortable in risking that amount. So we went back to the drawing board and we defined an amount he was happy to risk, right? What would you be happy with to lose with each trade? That's the question you need to ask yourself, okay? Is it £5 or is it £50 or is it £500, right? How much can you lose on a single trade and it feel nothing to you? It feels like, okay, bad trade, move on. I'll review it later. That's what you should be doing. The minute you start to become emotional about that single trade is the minute is a step closer to your downfall, basically. Okay, so it's important you remember to allocate the right amount based on what you're used to. Okay, now when it comes to defining the stop loss, there are a few areas that you need to sort of predefine. Let's see if I sort of remove some of this. Come to sort of a blank view. Now this is what I tend to first look at. So to define the correct stop loss, I'm just reviewing if there's any other questions. Okay, no. To define the stop loss, the first thing I will look at is to determine the distance. What's the average distance that I'm looking for when the distance from my entry point, so distance from my entry point to my stop loss, okay? What's the sort of, what's been the average, okay? So you need to determine the distance from your entry point to your stop loss. Now, I'll tell you why this is important. This was not important to me a while ago, but now it's become actually quite important because if I'm allocating a certain lot size to my trades and I have a maximum exposure limitation there, now if I have a 50 pip stop loss or a 15 pip stop loss, the amount of lot size I can get in will vary drastically, right? So I want to maintain a certain level of distance from my entry to my stop loss where it allows me to make the same return for the same amount of move that takes place. And I don't want, where I'm taking a, 3 lots position on one sort of trade and taking only a 0.3 lots because I've got a 100 pip stop loss, right? So I'm looking for much larger movement to take place, right? And that's when you sort of view whether you're a day trader, swing trader, and according to that profile, whether you're a day trader, swing trader, as a day trader, your stop loss should be somewhere between 5 to say 30 pips, no more than that in my opinion. If you're a swing trader, your stop loss should be 30 to 60 pips. Right? Maybe you look at the daily trading range, the DTR, and the way you look at the DTR is you look at maybe somewhere where you can define what is the average pip movement of that asset that you're viewing over the last 2 to 3 weeks and take a certain percentage of that to define how wide your stop loss should be. Okay, so the distance to your entry point and your stop loss is an important factor, and that's where you start to look at the DTR. Okay, the daily trading range. Okay, you need to monitor the daily trading range according to your trading style. That's an important factor. Okay, now there are a few more areas as well. It's not as easy as that. The next step would be is you need a technical reason, right? You need a technical reason. That's where your TA comes into place, right? Your technical analysis, right? It's pointless me defining, okay, I'm looking to go long now. I've got a downtrend over here. Price is broken through over here. I'm just going to get in. I'm not going to get in on the break of my TA reason, which is break of the previous high over here. I'm just going to get in now, just for the sake of it. That's not the correct approach. Your technicals, the whole point is do remember, right, you carry out a detailed sort of morning process. You take part of these video tutorials and these webinars, right? You do a lot of analysis on your charts. You do all of that work to look for that trading opportunity. But as soon as you're about to take the trade, you just take it for the sake of it, right? Or once you're in the trade, a single candle puts you off the entire idea. That shouldn't be the case, right? Put in relevance to the amount of analysis you do, and it should be done in each part, not just your setup. Way too many traders focus on just setup. It should be your setup, your trigger, your execution, and your management of your process. Okay, so remember, that's where TA matters, right? I'm only going to take this trade if price breaks through this previous high, then I'm looking to go long, for example. Okay, so that's the other part to it. Now there's two other areas. Now it's the ongoing reward to risk ratio, right? So I call it the ongoing reward to risk ratio, right? Let me see if I can sort of get this going. Ongoing reward to risk ratio. Now everyone knows about reward to risk ratio on the outset. Okay, you know. Okay, let's now sort of define this, right? So I'm looking to sort of enter here. I'm targeting all the way up there, right? So I'm targeting somewhere about there. That's my TP, and my stop loss is over here. Okay, let's just go with a very simple sort of, you know, overview there. Okay, that gives me sort of a 1-to-1 reward to risk ratio. Let's just assume that. Okay, so from there to there, it's 1-to-1 reward to risk ratio. Okay, got a 1-to-1 reward to risk ratio in this trade, and then I take this trade, and I've totally forgot about the reward to risk ratio. Right, price could sort of trend higher, go in my favor, and it's there now. It's there, right? Price is there now, and I don't even check the reward to risk ratio. You should always check the reward to risk ratio. Now, price is here. From this point to my target, let's just define that as 1. From this point to my stop loss is now 3. So it's 3-to-1 against me at this point over here. Therefore, my ongoing reward to risk analysis is determining that I should look to trail my stop loss. Okay, and then you follow that same process. Then you look at the technical reason to move my stop loss. So my stop loss from here goes to, say, somewhere there. Okay, so I'll have a better reward to risk ratio. Right, I'll move my stop loss to the previous low. I look at the distance from my sort of entry to stop loss and so on. Okay, am I maintaining that same distance as I expect as an in-day sort of day trader? Right, is it maintaining 30 pips, for example? Right, so those are sort of the factors you look at. And the final most important part is volatility, right? You need to put a lot of weight on volatility. It's important you put a lot of weight on volatility, okay? Now, how do we determine volatility? There are a number of indicators out there that you can apply volatility, defines the volatility, right? We looked at the VIX index. That might be sort of the first thing you do in your morning process. Let me look at the VIX. Is the VIX, has it got greater volatility than the previous day? Right? Add a moving average to it sort of to help determine that answer, right? So you need to, now when you have an increase in volatility, that may determine that you need a wider sort of distance defined to your sort of DTR level, your sort of from your entry to your stop loss distance, right? Okay, so you need a wider distance, right? To just in case there's a large fluctuation that takes place. You see, last thing you would do is get stopped out on a spike. That's the last thing you would ever want, right? Large sort of stop loss hits, it completely reverses, goes against you, goes in your favor initially, what you initially expected, right? So your distance from your entry to your stop loss should widen if there's larger volatility. Right, but also now you need to focus on the other two areas, right? I need a stronger technical reason. I need a much stronger, more confidence to my technical reason to take that entry, right? Because when there's greater volatility, it can go either direction, right? A lot new information can step in and it can reverse instantly, right? I've got to be sure that my setup is a very good setup. Right, so increase the confidence you require to your sort of technical analysis. But also, you've got to make sure as you're getting a wider stop loss, right? The distance from your entry to your stop loss is wider. Your take profit has to match your expected reward to risk ratio. And that's where you might look for a better reward to risk ratio in this, right? Now, if you follow this process, there you go. That just generally is determining that you're probably going to take less setups. You're probably going to be taking less trades because of this now, because of the volatility. right? And that's where, as I stated right at the beginning, sitting in your hands is taking a position, right? There's a lot more I can go into it, but I am sort of running out of time as well. Hopefully that explains quite a bit. Now, just to sort of finalize on this, the indicators that could help you determine stop loss distance, but also in trade, sort of in trade stop loss management, sort of trading stop losses, is, as mentioned sort of in the chat over there, is ATR. ATR is a great indicator. Average true range. When you add this, it's an oscillator below your price. It tells you to the pips or the current volatility. Right? I would say is when you add the ATR, it's set to 14 periods. Maybe you want to increase or decrease that based on the type of trader you are, whether you're a swing trader or day trader. Okay, how much information you want to take into this, right? The ATR is a good one, right? But don't forget the other indicators. Exponential moving averages can be great in defining where your stop loss should be. One of the best indicators I like is the parabolic SAR, right? Parabolic SAR. It actually sort of stands for stop and reverse. Stop and reverse. That's what it stands for, right? So it can help you determine where to place your stop loss. Or it could be a combination of 2 or 3. Okay, so those are the 3 indicators I would sort of definitely encourage you to understand, research, and apply. Okay, and that's it from me, guys. That's it from me. I hope you've enjoyed this webinar, guys.